So this bounce that we're having today, very expected, could go another day. We could rally all the way back up towards the kind of this 20-day moving average over the next couple of days because we are decently oversold. We're still on a sell signal, which suggests that there is pressure downside on prices. So we're still in this corrective phase. That's not over yet until that signal flips back to a buy. But we're oversold enough here for a bit of a decent rally.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart, welcoming you back here at the end of another week, joined as usual by my good friend, the jouncing Lance Roberts. How you doing, Lance?
I'm good. So explain to me this week?
All right. So a jounce is basically a bounce, but it's a sharp bounce. It's like a bounce with a jolt, right? And so I'm trying to relate it to what the markets have done over the past week.
Yeah.
And I should say, first and foremost, for many, many weeks now, you have been warning people that markets had been overbought and that we were due for some sort of cooling off, probably some sort of sell-off. We definitely got that. We got it in spades in certain high-flying stocks. Stocks like Tesla, you were talking about a 5 to 10% correction. Tesla had a 10% correction overnight when it reported its earnings. Exactly. You did say last week that you wouldn't be surprised to see buyers show up relatively soon at the technical levels that we were at, and that's what we saw this week. So I guess we'll pull up the S&P stuff in just a moment. But anything you want to say just in general about the market action we've seen?
No.
Playing according to script or stuff that anything surprising about it?
Well, it's always interesting, right? Because we have been talking about the need for a correction, and we're getting to the right time of the year for a 5 to 10% correction. And it's always fascinating that when you have a downturn, immediately, there's these kind of headline stories. The AI trade is dead, and these companies are out of it now. And look, this is just a very normal correction process. Volatility remains really, despite the 3% correction, volatility remained fairly subdued. It rose to about 16 from 12. So, it had a decent advance, which you would expect with a sell-off, and particularly and we had the first 2% sell-off in roughly about, I don't have the exact number of days, I haven't counted them yet, but it's like right around 350 days. A fairly long streak without a 2% correction. The S&P had that this past week, but it just drags everybody out of the woodwork, media-wise, to assign a reason to it, right? And I was explaining this on the radio show this past week, saying, if I took a paintbrush and I splattered a bunch of paint on the wall, then had you stare at it, our minds want to make something out of chaos, right? We don't like chaos as individuals, and so we try to form a pattern or something out of it. So we see faces and clouds and rainbows, whatever. And that's what we do with markets. So when markets have these corrections, we try to assign a reason to it. And sometimes it's just a correction. It's just, as the old saying goes, sometimes a cigar is just a cigar. And that's really kind of what this is. It's been a very healthy rotation at this point. A good sell-off in some of these names. And look, people have been very underweight tech stocks so far this year. This is going to be an opportunity. We're going to see large cap funds, adding those positions into their portfolios here shortly. And I'm not saying we're done with the correction. I think there's still more to go. This could last another few weeks to maybe even a month or more, kind of like we saw last summer. We had a 3-month correction. It just kind of kept grinding its way lower. That could certainly be where we're heading to, because we're getting ready to go into an election, and markets tend to de-risk before an election. So, I'm not saying this correctional process is over, but so far it's been fairly normalistic that you would expect.
Okay. Well, I'll tell you, my brain trying to make sense out of the chaos when we had that 2% down day, I immediately went to, what did Lance do? Lance trip over a cable here? Did he pull a CrowdStrike on the markets?
Well, I said the market crashes when I go on vacation. Just wait until I got back this time. So,
yes. So, boy, you really got to start, selling in advance subscriptions to when you're going to be out of the country, so we all know that it's all going to go down.
Exactly.
One thing I do want to note, just so it's not lost in the shuffle, because we do talk a lot about overvaluations in the market. And just to remind everybody of your main point there, Lance, which is valuations are a terrible indicator of short-term price movements, but they matter in the long run. We finally had a 2% correction in the markets. I think the S&P was down, what, like 2.3 or something like that on the day.
Right. Yep.
And it had been a long time since we had a correction like that. Right. Two, I mean, big picture, that's not a huge percentage of the market, right?
Right.
It's not like a 1987 style drop or whatever. But the market, just the Magnificent Seven stocks combined lost over $750 billion worth of market cap that day. If you total the entire market, I think it was more like 1.1 trillion.
Right.
And I just underscore that to say that, like, the stakes get pretty high the higher and higher these valuations grow.
Right.
And look, it's not a mortal wound to the market, and the market's recovered a lot of that already. But it's we're at the point here, especially if we bring in the argument about how much of this market cap might be kind of phantom market cap and whatnot. The magnitudes are big. In fact, I think they're bigger than most investors' brains can wrap their minds around, and that's not necessarily an issue while everything holds together. But if we get a bigger downdraft than perhaps even you expect, Lance, I'm not saying we're going to,
Right.
but it could be on a magnitude that really could catch us all by surprise, given the size of these numbers.
Well, and again, but you got to keep this in perspective, right?
Agreed.
So, Nvidia. Look, so we launched our dividend. Just to give you an example, right? So we launched our dividend equity model in January the 19th of this year, and Nvidia is one of those positions. It was up almost 100% before the correction. And so, yeah, it corrected and it lost a good bit of market cap during the correction. Absolutely, right? But you got to put that in scale of how much market cap those stocks have gained this year. And and when you look at the markets, these corrections in mega caps is not uncommon. In fact, I wrote a piece yesterday for our daily market commentary that we put out kind of every morning before the market opens, and I showed this chart of just taking a look at the S&P 500 versus the mega cap stocks. And what you'll notice is that whenever the market goes through a correction, and this is because these top stocks make up 35% of the index, they correct with the index. So and totally unsurprising, right? I mean, this should
Right.
not be a revelation.
Just to restate it, the index corrects with them is the better way to say it, right? Yeah.
Absolutely, absolutely. So yeah, these stocks can have a decent correction, and surely will scare the bejeebers out of you, if you're just looking at it on a very short time frame. But these stocks are just correcting within an ongoing uptrend of the market. There's nothing wrong or unhealthy with the correction that's going through, and there's nothing that deems that this is the beginning of a much bigger corrective cycle in the markets. Now, could it be? Sure, right? This could be the beginning of the next big correction, but we just don't have anything right now to gear that. If you look at credit spreads on quality bonds, there's no risk there. We talked about last week. There's some minor increase in credit spreads at the very junk end of the curve, but once you get into corporate bonds and AAA bonds, et cetera, there's no credit risk. The economy is doing well. Just printed GDP yesterday at 2.8, so not a big surprise there. And if you take a look at kind of the rest of the market, there's not take a look at regional banks. They're doing great. So all of this fear about Silicon Valley Bank and regional bank failures, that's kind of in the rearview mirror now. I'm not saying that's over by any stretch of the imagination, but right now, when we look at the market from kind of an overview, a kind of a 30,000-foot overview, yeah, we're having a correction, but there's not the drivers for a big market meltdown that a lot of people are kind of hoping for, I guess.
So totally agree. And just the point I wanted to make was just, it's sort of like if you're doing a high wire act 5 feet off of the ground versus 500 feet off the ground, right? The acrobat may still have the same amount of balance in both cases, but if he were to fall, one would be a lot more damaging than the other. And I'm just saying, to your point about, Nvidia's up over 100% over this year, right? And that's been a gargantuan amount of market cap that's come along with that, right? The point I'm just trying to say is we just hit a 2% correction, and basically over $1 trillion of market cap vaporized, right, overnight. Now, again, a lot of it's come back, and I'm not saying this is all going to unwind tomorrow, because like you said, it doesn't look like it from what we're seeing in the markets. I'm just saying,
Yeah.
if these concerns about like, hey, especially with the AI mania and stuff, and the market is overinflated, I'm just trying to underscore the size of the altitude we're at, because if it did correct, say 20-30% and not just 2%, that would be a ton of market cap that was lost, and then the knock-on effects of sort of the negative wealth effect from that would be big, and we just need to be mindful of that, is all I'm saying.
Yeah, and yeah, absolutely nothing. That's right. I don't really look at markets in terms of market cap so much. Yeah, it's a measure of market cap, which is simply, if you don't know, just to explain what market cap is for everyone, it's just the price of the market versus the shares outstanding. So we have reduced, as an example, we have taken the number of publicly traded companies from over 8,000 to a little bit more than 4,000 since the turn of the century. So we've wiped out tons of market cap through acquisitions and mergers and leverage buyouts and bankruptcies and going private and all kinds of other issues. So you've got a lot more dollars chasing a lot fewer shares out there. So you're going to have elevated levels of market cap. So when you talk about corrective cycles in the market, so we're going to have a 20 or 30% correction. Yeah, it's going to be devastating to a lot of people that don't know how to manage risk, and they've gotten into the market very late in the game. So when they take a 20 or 30% decline, it's going to wipe out all of their gains and a lot of their capital, because they just haven't been in the market for all that long. For people who have been in the markets for a whole lot longer, it's going to be a hell of a good buying opportunity when we get there, right? But you have to navigate that corrective process. But to your point, there is the risk of a 20 or 30% correction in the markets. Absolutely. That would even violate the bullish uptrend of the markets, by the way.
Which is so bananas, right? Yeah.
That would just be a correction. But yeah, that is certainly possible. But again, you're going to need a catalyst for that. And one of the as you and I have talked about before, the big factor is what gets people to sell their ETFs. That's going to be the question.
Right. And hey, in a few minutes, we're going to look at the technicals anyways. And your point has always been, we're going to see some wobbles in the technicals before we see some massive cascade. Right. A couple things real quick. One, just because some of the finance wonks watching might chime in the comments on this. I believe market value is shares outstanding time price per share. Market cap is market value plus debt, right?
Well, it depends on when we talk about market cap, right? In terms of the S&P 500, we say, what's the market cap? Market cap is priced by shares.
Okay. All right. Maybe I'm misremembering my days as an analyst.
No. There's multiple ways to calculate market cap and market value and all these type of things. But generally, when we're talking about just in general, and we're saying, okay, what's the market cap of okay, so for instance, go look at pull up a chart on NVIDIA, right, or whatever, and it says, what's the market cap? It's price times shares. So, so again, but there's, and to the finance wonks that are out there, there's multiple ways that we calculate market value as well as market capitalization. So,
okay. All right. And then you mentioned credit spreads earlier. I was just going to ask about this. I think you've already answered my question, but yeah, you kind of sprung that on us at the end of last week, which is, hey, we're starting to actually see a little bit of worry in credit spreads, which you've long said, hey, that's going to be the real early warning indicator to pay
which to. out of a 2-hour-long video last week, that's the only thing you could come up with, title your video with.
Because it was it was like saying, hey, I've been hanging out with my friend for 2 hours and everything's great. And at the very end, he's like, oh, hey, and I think I might have cancer. Okay, well, I'll see you next week, right? It's like, whoa, wait a minute.
Yeah, but it kind of overshadows the whole rest of the video, which was everything's fine. There's nothing to worry about right now. Just, we took profits and, just kind of manage your risk.
Yeah. Well, look, but that's important new news. Now, again, I think you're saying, hey, it's on the lowest end of the curve. It's not that big yet, but it's just, we're noting that it's there now, right?
And look,
it sounds like you're saying it hasn't progressed much since last week.
No. Yeah, absolutely it hasn't. But that's where you would also expect to see stress start, right?
Right.
It's very interesting. Over the last couple of weeks, all the headlines are about the small cap rally, and it's like, oh, this big rotation from large cap to small cap. So first of all, yeah, that's occurred, but it's basically because most hedge funds were heavily leveraged long in large cap stocks because they're the most liquid. So if I've got to invest $1 billion at a time, or 100 million or 500 million, whatever the number is, I need very large liquid stocks to do that. So I buy Apple, Microsoft, Eli Lilly, etc. If I'm a hedge fund, I can't buy small caps. I would own the entire company in a lot of cases by trying to take those on. So a lot of these hedge funds were levered long and short small cap stocks. So when the reversal happened, and particularly we saw a reversal in the carry trade. So as you kind of see the yen dollar movements, that is affecting the yen carry trade. And that required a lot of these hedge funds to all of a sudden start to sell their long positions and then buy to cover all their short positions. So you saw this major upheaval between large cap sell off and the small cap rally. That's not sustainable. As we talked about before, the Russell has a tremendous number of problems with it. 40% of the companies don't have earnings. And so there's a chart that's been running around lately. It shows the valuation gap between large caps and small caps. Everybody's like, oh, look how cheap small caps are. Well, the problem with that chart is that most of those charts strip out all the companies to get values that don't have earnings, because you can't do a valuation on a negative earning company. So you can't do a PE. So you just strip out all the bad companies and say, oh yeah, it's cheap, but you got to be really, really careful with that. But you have this, kind of situation that's going on, but you would expect that when the economy starts to slow, which it is, that you're going to see stress in the companies that are the most highly levered and the riskiest, and that's small cap, mid cap companies. They have the most amount of floating rate debt. A lot of those, there's about 20% of those companies that have to issue debt just to stay in business, right? They're
the zombies, yeah,
exactly. It's called zombies. So those are some of your riskiest companies. And so when you start to see cracks in the economy, the first ones that are going to show up with credit stress are the junkiest of companies, right? So those are your triple C's to double B's. But once you get into your higher rated companies, your Apples, your Microsofts, Googles, and look at those corporate bond yields versus treasuries, there's no risk there right now. There's no credit stress going on because those are highly liquid companies with, it's what when we're buying corporate bonds, those are what we call money good. They've got so much cash on the balance sheet, they can pay off their debt tomorrow if they wanted to.
Okay. So just to go to back to my inappropriate cancer analogy, I think what you're saying is market's just gone to the doctor and the doctor has said, we think we might see signs of a small tumor. We're going to biopsy it. We don't, it may be benign. We don't know yet. We don't think it's spread, but we're just starting to order some more tests, right? So it's like not a cause for alarm, but we've seen something, on our scans that just makes us say, we should watch this.
Yeah, I think that's a pretty dire analogy because I just went to the doctor this week for my annual physical. And if the doctor said, hey, I see something here, all I'm going to do is just be terrified until I find out the results. So it's more like, I would say it's more like you're coming up to an intersection and it's a yellow, it's good. It just went from green to yellow and you have a choice. You can either, go faster or slow down. So, I think that's a better analogy for what we're talking about. It's just a flashing yellow light. Suggests there might be some construction ahead or whatever it is. But just pay attention.
Okay, that's probably a much nicer analogy. All right. So I'm still trying to get to my second bullet here, but you mentioned a few things. I just want to make sure we clarify for people. So we've seen some headlines over the past 10 days or so. Hey, there's maybe a great rotation underway, right? Mm-hmm. From large cap to small cap. The headlines giving the sense of this is the new investing theme going forward. And I think what you're saying is no, this is more a mechanical reaction to other things going on here. Did I hear you right?
Yeah.
Like a short-term mechanical reaction.
Yeah, absolutely. And, this is something that, as always, we're kind of examining these rotations. We're looking at them because we have a whole system set up inside of SimpleVisor that looks at market rotations between factors, sectors, et cetera. So we're always looking at where money's coming from and where money's going to. But the problem, and I just wrote an article on this week, talking about this idea of this Yahoo Finance came out and said the new bull market's just getting started, and the thesis is that because of this rotation, breadth had improved in the overall market. And that's absolutely correct. If you take a look at the breadth of the market, the New York Stock Exchange advanced decline line had been declining while the market was going up. That's called a negative divergence. And we
Yeah.
had seen negative divergences across relative strength, across breadth of the markets, the New York Stock Exchange. Well, because of that rotation, all of a sudden that breadth completely recovered, and we're back to all-time highs on the New York Stock Exchange advanced decline line. Breadth improved markedly. And that's a good sign, right? That's very supportive of the bullish case. But the problem with the thesis, which is this is now the great rotation, is that, again, kind of going back to what I was talking about, 40% of these companies have negative earnings. A big chunk of them have, and this is the 20% that has higher debt servicing costs than they actually make in profits. So they've got to keep issuing debt to stay in business. But importantly, this was from Simon White over at Bloomberg, talking about the real yield curve expectations. Those are collapsing. That's not the type of thing that is beneficial for small and mid-cap companies, because those companies are highly dependent on economic activity. So if economic activity is slowing, which it is, that's where their earnings come from. So if the market rises in conjunction with earnings, which it does, the reason markets go up in price is because of the expectation of higher earnings. The issue is that you've got to have the economic environment in order to justify that. And that has not been the case over the last decade. And this is the reason that large cap stocks have vastly outperformed mid caps, small caps, and the Russell 2000. And will continue to do so going forward, because as we talked about before, okay, so first of all, you got 40% non-profitable, 20% depend on debt. They don't have the benefit of the passive investing flows that large caps do. Hedge funds, mutual funds, pension funds, et cetera, can't buy these companies. They have to buy large cap companies. So the concentration of flows is going to continue to go into large cap stocks. You're going to get short-term rotations into these companies, and we've seen this numerous times. We'll see this little pickup, and all of a sudden we've had this outperformance in mid caps. Everybody thinks this is the new era, and then it completely gives it up because the market rolls back to investing in large caps because it has no other choices, because of the fact that there's too much money chasing too few shares outstanding. And the more buybacks we do, the more which also, by the way, buybacks are another big factor of this. Only the largest companies do the vast majority of the buybacks. Small and mid-cap companies simply don't have the capital to do buybacks. Apple alone will make up more than 14% of all the buybacks this year that are going to be done. So one company is going to have a huge chunk of that. But that's why those stocks are coming up. And the more of these shares we buy back, we have more and more dollars chasing fewer and fewer shares. And that this just continues to kind of exacerbate this problem. And so anyway, I go through the fact that also there's a big difference. Back when we were back at the October lows, sentiment was extremely negative, versus today, sentiment's very optimistic. So if we're gonna have this massive rotation, sentiment is already very long, and investors themselves, so this is a composite index of equity allocation. Investor allocations, both retail and professional, are near all-time highs, not at lows where you would see potentially a big rotational shift taking shape. So there's a lot of headwinds that stack up against this rotation trade. It's great for right now, and it can last for a bit. I mean, this could last 2 or 3 months potentially, where small and mid caps outperform. And I want to be really careful with that statement. You'll hear this a lot. They'll say, "Oh, small caps outperform large caps during this period." It just means they didn't go down as much, right? It doesn't mean you make money. When you hear about outperformance, you got to be very careful with that. It doesn't mean you're making money. It just means you didn't go down as much as if you had been invested in large caps.
Right. It's a relative term, not an absolute one. Yeah.
Exactly. So you got to be very, very careful when people tell you this. Is like, oh, look back at 2008, small caps outperformed. Yeah, they did. They just didn't go down 50% with the rest of the markets, but they still went down. So those are the things to kind of be thinking about. But there's a lot of risk to this story about this big rotation in the markets. And again, we just wrote this article. It's on our website at realinvestmentadvice.com. It was out last Friday.
Great. Do me a favor, pull up the zombie chart again, just for a quick second. And I'm glad you walked through that piece, because you published two pieces this week. One was the bull market, could it just be getting started, which sounds very bullish in tone. And then the second one was
Oh, wait,
overly optimistic investors face potential disappointment. So they were really kind of warring titles, but sounds like you were kind of skeptical of the, you know, the
well,
great
actually,
rotations of the reasons you mentioned.
yeah, no, actually, the article, as the bull market is getting started, that was Yahoo's title, and
Right.
basically, the entire argument is against that.
Yeah,
Is that the
got
bull
it.
market is not likely just getting started. We're likely closer to a peak in this particular bull market, and that doesn't mean a huge crash, by the way. So just don't jump on that headline. Say Lance says the crash is coming. That's not your headline for this week. It just means that we have put a lot of capital and market capitalization and valuations are at very, very high levels. And it does suggest that forward returns are going to be lower. That doesn't mean the markets crash, but it also means that probably we won't be seeing 12% annualized returns like we saw over the last decade.
Got it. Yeah, and we've talked a lot about this in the past, so I won't rehash it here, but I totally agree. All right, so I just wanted to pull this up because I'm sure a lot of viewers have the same question in their brains that I do, right? So, definition of a zombie company is it basically it's has enough debt and it's losing enough money that the only way it can service its current debt is to borrow more, right?
Right.
So these are very vulnerable companies on a relative basis, right?
Right.
So you look at this chart, the percent of zombie firms has grown dramatically. It's now at about 20%, right? Which is scary because that's 1 out of 5 companies, right? That's not a small share. But as we started hiking interest rates, as the Fed started hiking interest rates, I and I think many people said, oh, all right, it's open season now on zombie companies, right? We're just going to start seeing bodies, float to the surface right and left here. And to a certain extent, we've definitely seen some companies do that, but we haven't seen this massive wipeout
Right.
of this quintile of the market yet. And I guess sort of 2 questions for you. I don't necessarily expect you to have definitive answers to them, but why not? And I think part of that reason is these companies were able to lock in low cost debt when it was still low, and they're surviving off of that. But we now have this maturity wall coming up, right? So, are there any other reasons besides just having locked in low debt early on that's for why they haven't died yet? And then secondly, how worried are you about trouble in this space, given our higher for longer interest rate regime that we've had, given the maturity wall coming up? Is there a way to not have a reckoning here, I guess is what I'm asking.
Well, it depends on what the reckoning is. I mean, again, there's a lot of ways to resolve these, debt issues. First of all, so to your point, the reason a lot of these companies haven't gone belly up yet, and a lot of them have, we've seen quite a few Cons that as in 15 states is filing for bankruptcy. Big Lots, which was part of Kmart, back in the day, they're closing stores down. So
Right. That's what I meant. I mean, we are seeing
yeah,
some of this,
yeah.
but we're not seeing a mass wipeout yet that many people feared could happen. Yeah.
Well, yeah, but it's only because, well, first of all, a couple of things. One, these companies in a lot of cases haven't hit their maturities where they have to refinance their debt at higher rates. So it's kind of a race against time right now. Will the Fed cut rates enough to allow these guys to refinance and not completely, dissolve themselves? The other side of it, though, too, remember, was we had trillions of dollars worth of stimulus that came into the markets that supported these companies, right? I mean, so people were spending money that they didn't have, that they were given, right? And so that kind of helped buffer some of these other issues, and people were able to take on additional income from all these government support, stimulus, everything else that came through. Then that kept these companies in business for probably longer than they should, and that some of these should have been. Still a lot of these, though, that are certainly on the ropes, and it won't take much to see a rash of pickup in bank. And we're seeing a pickup in bankruptcy. You're seeing a sharp rise in consumer delinquencies of credit card debt and auto loan debt more than 90 days. So that cycle, as you and I have talked about ad nauseum, there was so much money, it just delayed that ultimate impact that is still coming. Now, commercial real estate's been one of the big concerns. And as you and I have talked about before, a lot of banks have been very aggressively resolving that commercial real estate issue before it becomes a big issue. So they've been getting a lot of these assets off their books at very cheap prices. And I'm sure a lot of these small and mid cap companies are finding creative ways to refinance debt, extend credit, those type of things. But that is a bit of a game of chicken that you better get it done before the kind of the clock strikes noon, right?
Okay. Well, all right. So then just ask me for your gut feel here. This isn't a prediction I'm going to hold you to, but how worried are you about the vulnerability of this quintile over the next 2 years?
Well, we have some small and mid cap exposure in our portfolios, but these are really good, high quality, fundamental companies.
Yeah,
So
you're not owning the zombies, I imagine. Yeah.
yeah, exactly. Yeah, we do our homework. So if I'm a large cap manager, and the bulk of our portfolio is large cap stocks,
Mhm.
provide a dividend yield or the larger companies, and we do have some of the mega caps, but yeah, we have a lot of other large cap companies. If small cap and 20% of the small cap index went belly up tomorrow, it wouldn't faze me. It would hit the markets, right, because of this going on, but money's going to rotate into safety. And where's money going to go? It's going to go into bonds and large cap stocks. So I'm just saying it depends on where you're allocated. If your whole investing theme is small and mid cap stocks, you better know what you own.
Oh, yeah,
You take a
absolutely.
lot of risk.
Yeah, and I'm sorry, I don't necessarily mean it like, oh, well, zombie investors get wiped out, because I think you'd be kind of crazy right now to be holding on a ton of zombie company equity. To me, I was thinking more about macro, like, if we had, I mean, they're not all going to die, right? But if you had a material amount of 20% of the corporate fleet start defaulting on its debt, right? What economic impacts would that have? What would that do to the banking system? And would that create ripple effects that would still
Oh,
hit the large cap side of the market because the overall economy is now struggling? Yeah.
yeah. No. So yeah, from that standpoint, sure, you're going to definitely, a lot of these small and mid cap companies, their debt doesn't come through JP Morgan. A lot of these companies have, more of the regional bank exposure. So this is potential,
Yep.
risk back to the regional banks for sure. If they
Right.
all decided to go belly up at once, that would definitely be an exposure to the credit sector. And again, that's one of those credit risks we kind of have to pay attention to. And certainly, and if these publicly traded companies are going out of business, there's going to be a lot of private small businesses going out of business as
Sure.
well, because this is all going to be coinciding with a fairly deep economic contraction. So again, you kind of got to build out a thesis for a very, very sharp slowdown in the economy, that really all of a sudden we have a drastic drop off in spending. And so the revenues for these companies completely dry up, like literally overnight. And then you got all kinds of problems. So yeah, there's certainly that risk there, but you need the catalyst.
You need the catalyst. And I think there are two potential sizable ones, at least that a bleacher seat guy like me can see coming. One would be a slowdown in consumer spending. Maybe it'll happen, maybe it won't. We don't really know, right? The other one, though, is more dependable, which is, unless interest rates come down materially, the more time that goes on, the more of these companies hit their maturity wall, right, and have to re-rate at a much higher debt. So that one I feel like is a more credible threat. And if we get both at the same time, then it's like, all right, Katie, bar the door, right? So, all right, well, I appreciate you taking this tangent with me, but it's funny because, like a year and a half ago, I remember hearing a lot of chatter about concerns about zombie companies. And honestly, I haven't even heard the term zombie in months. So when you brought the chart up, I wanted to just talk about
Yeah.
it briefly. Secondly, though, just on this topic while we're here, you mentioned that a lot of these companies, they're not borrowing from the JP Morgans of the world, they're borrowing from smaller banks. I imagine they are also borrowing from the private credit market, right? And I think we've talked a little bit about this. I know I've talked with a few other people on this channel. There's some outstanding concerns about the private credit market just because it's much more opaque than the public credit markets, right? And these private lenders who have gotten much more involved in lending over the past decade, they're not beholden to the same regulatory scrutiny as the big banks and whatnot. And so there's just a question mark of, we don't know if they're bad loans are being made, right? People are saying, well, we don't have to worry about a subprime issue like we had back in 2008 because banks are, much more strictly regulated on that now. Okay, great. but we really don't know what's going on in the private credit market. So I'm just curious, what's your thoughts on the integrity of the private credit market? And I know you're guessing in this case because we don't have a lot
Yeah.
of data.
So first of all, a big chunk of the private credit market is kind of like private equity. It's some group of people, some firm, right? And then they go get a bunch of investors and they say, we're going to invest in private credit. And so kind of like building a private equity fund. And I just wrote an article just recently about the risk of private, why always ask the question, if somebody comes to you and says, hey, I got this private credit fund, that we're loaning money to these companies, ask yourself, why are you so lucky? Because there's very, very big companies that do private credit and they're very adept at it. But there's a lot of people that get into this space and they start up a fund. They say, okay, we're doing a private credit fund, and they're loaning money on a private basis. So, the difference though is that if that fund goes belly up, right, all its investors lose money, but that doesn't impact the credit markets, right? Because this is, in this particular case, we're talking about private credit funds where a lot of these private credit investments come from. It's just a pool of investors that all put their money in that just lost all their money.
All right. So just to be clear, it doesn't have the contagion risk that if a bank goes down, not only does it impact that one party that borrowed from them, it impacts all the parties that borrowed from them.
Exactly.
Right? Yeah.
It's you don't have you don't have as much of the regulatory risk when it comes to the bankings. Now, if you start to see a lot of these private credit funds go belly up, it will impact the banks, because all of a sudden people are going to go, well, how much exposure do you have to private credit? And remember, it's always baby out with the bathwater, right? So if a bunch of private credit funds start going belly up, it will impact the banks because of the relationship. In a lot of cases, these private credit funds have leverage through a bank. There will be a spread, so it is worth paying attention to. But it's not like subprime was, right? So we can't really, and this is really what I'm trying to differentiate, is that when people talk about credit, the first thing they think about is subprime crisis, and this is going to happen, and the market's going to go down 50%, and the world's going to end. That's not really the setup we have here. To a degree, private credit is an issue, and I think there's risk there. I think there's a lot of unknown risk because we don't have all the details on private credit funds like we do with bank credit, right? There's plenty of data on that. A lot more of this private credit is more opaque, so we really don't have our hands around exactly how much underlying risk is there and how concentrated is it.
Okay. All right. Well, I don't know.
And just FYI, I'm not a private credit fund guy, so
yeah,
just my opinion.
Yeah, and we don't have any data at this point to, do much validating or contradicting of what you've said. So we'll just keep an eye, and obviously, if we get into rougher times in the economy, I'm just noting this is one of the things that maybe could kind of feel like it comes out of the blue for a lot of people, just because we don't have a lot of data on this space, right?
Well, and the other side too is always that, this is always the problem with private equity funds, private credit funds, anything with private in the front of it, right? Private real estate funds. This is always a problem with it, is that, the big boys, the guys that have access to all the really, really kind of the rich crowd, right? They get all the best deals. And the issue is that if I get a bunch of investors to give me money, I have to deploy it. So if I'm down that food chain a bit, I'm getting money, I have to deploy that capital. Otherwise, in a certain time frame, I've got to give it back to the investors. So I'm more challenged to get that money invested, and what happens is a lot of these funds at the bottom end of the tier wind up getting poor quality deals, and that's where the risk is. And that's why I go back to what I said earlier, is that if you're approached by one of these deals, you can make good money with private. I do private credit personally. I'm very selective about how I do private credit. I do private equity personally, not through my firm, just me personally. I do private equity. I'm very selective about how I do it. But for most people that can't do the research, don't have the analytics, don't have the background to do the analysis, you wind up investing in deals of very poor quality. So always ask yourself the question, if somebody comes to you and says, hey, I got a deal for you, just ask yourself why you're so lucky, because if it's a really good deal, somebody else would have done it.
Well, and that's, again, sort of why I bring this up. So you're talking about adverse selection that happens in these industries, and we've talked about it before, which is if you're not one of the big firms, which all the good deals go to first anyways, and you take all the ones you like, what's left over, as you said, is what the rest of the guys have to fight over. And because they have to deploy their funds, they're deploying them into by definition, not the best opportunities. And so almost kind of like the Jenga tower, you get the bottom part of the market that starts to fall apart first because it had the crappiest deal
Yeah.
book, right? And then the question is what's the contagion risk from that? Yeah.
Right. And don't get me wrong. I'm not saying that all private equity is bad. And if you're approached with a private equity deal or a private credit deal, I'm not saying they're all bad. You should immediately, disregard it. But look, when it comes to investing your personal capital, if you can't do the analysis, if you can't do the research, if you can't read the documents and understand what you're reading, don't do it. It's not worth the risk. I mean, because if you really don't understand, as always say, invest in what you understand in. You really need to understand what you're investing in. And today we make investments because they're simply going up in price, or we heard on some YouTube channel, some guy said, hey, buy this fund or X fund or whatever, because it's going to go up. So we do that, right? But that's just gambling. And in the liquid stock market, that's one thing where you can, okay, I made a mistake and I can sell it and get out of it. And a lot of these private investments, you can't get out of them. And so once you're in them, you can't get out. And if things start to go belly up, they have what's called gating. And basically they just gate all the withdrawals and you can't get your money out, period. And you're sitting there looking at your money go down in value and you're watching the world fall apart. And there's absolutely nothing you can do about it. And the problem for smaller investors is, in a lot of cases, that's a big chunk of their capital. High net worth individuals, some guy that's got 50 million or 100 million bucks, they'll have 15% of their portfolio in private investments. That's okay. If they lose 15% of their money, it doesn't kill them. For a lot of private, smaller and individual investors, like the people that watch your show, it may make up 25 or 30 or 40% of their portfolio. And so when something goes belly up, it wipes them out. And it's just not worth the risk. So there's just a warning. I'm saying everything is bad and it's all crap and you shouldn't invest in it. Just really understand what you're doing, because there's a lot of risk.
There is. And I'll even say from personal experience, there was a time where I had a private equity investment, and it was probably at one point maybe like 25% of my net worth. And there was a period where I wasn't sure how it was doing, and I was locked into it. And I just remember a really sort of sleepless, awkward period of time where I felt trapped. Fortunately, the investment has continued to do well over time, which is good. But I still remember that visceral sense of fear and not being able to get my money out and just feeling really, vulnerable. All right, and folks, I didn't mean to make such a diversion here into the private side of things, but it's instructive. I think it's useful to understand, especially for the risk reasons we talked about. You're going to hear a lot more about private equity coming up in an interview that I just recorded with Pulitzer Prize winning journalist Gretchen Morgensen. It's a fascinating discussion. I think that's going to be coming out next Tuesday. It was supposed to be this Sunday, but I bumped it for Melody Wright's interview this Sunday. I swapped it in for Sunday because it's so timely. I'll probably mention that a little bit later in this video, but it's about what's going on in housing, which is really interesting right now. But just to underscore, Lance, Gretchen has spent a lot of time covering the private equity industry, written a book about it. She's definitely coming at it from the evils that it can do. Mm-hmm. But just to underscore the point you made, it's a tool, right? It's not a good or bad tool. It's how it's being used, right? It's like an axe, right? You can use an axe to, create lumber and build a building to house your family in, or you can use that axe to murder your family, right? Like a psychopath, right? It can be used for good or ill, right?
I didn't see you going there. I thought you like use that axe to lop off your foot, maybe. But not.
Yeah, no, you could go full Lizzie Borden, right? I mean, so fundamentally, there's nothing right nor wrong about it. It's how it's applied, right? Although right now, Gretchen would say.
Yeah, we've had a conversation twice this past week on our YouTube channel, which is about annuities, insurance, and all these type of things. And these are all great products. They're sold in a lot of cases. They're sold, not planned for.
Yeah.
So people get in, and annuities get a bad rap because there's a lot of advisors will sell an annuity because they have a high commission, even though it's not the right thing for the client. But annuities can be a great thing if used properly. Life insurance, whole life insurance can be a fantastic thing if it's used properly. Private equity is great if it's used properly and you really know what you're doing. But it's just, and Adam, this is always the case. Every investment vehicle is a good tool, right? And if you have a toolbox, you should have all these tools in there. Doesn't mean you use them, right? I've got some tools in my toolbox I've never touched. I bought the tool. I'm sure I was going to use it. I've never used it. But the point is I've got it in the toolbox. If I ever need it, it's there. I can drive a nail with a screwdriver. It'll work. It's gonna be a lot of bloody fingers, but
Yeah.
I can do that, or I can use a hammer, right? And so, when you look at your investing in your own world and how it reflects on you, always ask your questions about, what's my liquidity risk, what's my safety, what's my return expectations, how does this fit within my overall allocation? All those questions, because if you can't really make it fit, don't buy it. And if you don't understand it, don't touch it.
Absolutely. Okay, so a couple things. Folks watching, if you'd like to see some, sort of deep dive videos done on this channel on topics like annuities, when do they make sense, how to use them responsibly, that type of stuff, let us know in the comment section below. And Lance, because you mentioned it, I get asked still probably weekly, hey, 2 years ago, Lance was talking about how to use whole life insurance as a way to do like
Yes.
personal banking, right? So we still get a lot of, and so you mentioned it, right? So of course there's going to be a flare up in comments here. Are you, do you want to do that? I mean, I can find someone else to do it.
No. Well, definitely do it. I know you're trying to orchestrate a conversation with Richard and Danny on financial planning, which is where that really kind of fits a whole lot more. So we can either do it inside of that conversation, or we can just do a conversation, here one Friday and kind of go through. And I would just say that I'll go through how I use whole life insurance and how I've used it and just kind of from a personal standpoint, and where the benefits are that I think are most useful. But again, however you want to do it, we can certainly do that.
Yeah. Well, let's do a dedicated one on that, just because what I'm talking with Richard and Danny about is more retirement planning, and I think that deserves its own full space, and trying to cram this in, which deserves its own full space, would be doing both an injustice.
Sure.
Okay, but I presume folks are going to be happy to hear that. Okay, we're finally going to actually do that personal banking using whole life insurance thing.
We got sidetracked with artificial intelligence, so.
Yeah. It's funny, I haven't even mentioned that yet, this discussion. Okay, so this is the sign of a good interview, where I still haven't gotten to my second bullet point yet, and I'm still not going to get to it yet because there's 3 other quick things I want to get your feedback on.
Okay.
One, you mentioned the action that's going on between the yen and the dollar. I don't think many people are briefed on what that is. Can you just give us the 30 seconds? What's going on between the yen and the dollar? I mean, basically the yen has appreciated a lot versus the dollar very recently. What's driving that? What's going on? What impact do you think that's going to have?
Well, so, first of all, currency balances are always very important, because again, if a currency gets too strong relative to another currency, it impacts trade, it impacts flows, et cetera. For a while, there was a lot of conversation, a few months ago, about how central banks were accumulating gold. And a lot of the gold bug channels were, I was like, oh, look how much gold central banks are buying. They know something's coming, you better be long gold. It had nothing to do with that. It's because the dollar was going up in value. And so there's 2 ways that I can sanitize a currency rise in the US dollar versus my currency. Is I can either buy gold, which is, guess what, traded in US dollars, or I buy treasury bonds, one of the 2, or I can do both. And we've seen both actually occurring. But that's just in response to currency imbalances that are occurring. And so again, if I sell a lot of product to the US, then if I bring all that revenue back, it's going to make my currency dramatically stronger than the dollar. So I sanitize that trade by either buying gold or buying treasury bonds. So we saw that. So we've just seen a lot of this action as of late. The one thing I was referring to earlier, though, is the carry trade. And this is where and again, this is one of the big issues with hedge funds. I put this tweet out last week talking about basically hedge funds are not short. They're not hedged. They have very few short positions in their portfolio. So I said, basically, you just own a very expensive index fund at this point, because they're not hedged. And what they've been doing, of course, is they will, buy Japanese bonds, or basically use, transfer. Let's say I've got $10 million. This is a rough example, but say I've got $10 million. So I go buy, Japanese JGBs, right? And then I bring those back, and I can basically leverage those bonds into US dollars and bring them back to my bank and say, okay, I'm going to have US treasuries to offset that because I get a higher yield. and then I can take that money and then leverage it as a stock. So this is how hedge funds leverage up. And so the problem with that becomes is when there's a big currency fluctuation between the yen and the dollar. And part of what we saw over the last week or so is a little bit of that unwinding of that leverage in that carry trade. So it's just a function of what's kind of been happening behind the scenes. But the strength of the yen is problematic relative to their ability to have trade, because again, as their dollar goes up or their yen goes up relative to the dollar, then you get trade imbalances that become more problematic for consumptions, economic trade, et cetera.
Okay, so the yen carry trade, it's basically an arbitrage, right?
It is. It's all it is.
And
It's a
so
way, it's a way to leverage.
Well, so it's a way. I'm going to say this the wrong way, but it's a way to make free money, right?
Yeah.
I borrow at this low rate, I then buy something that's paying me a higher rate, and I pocket the difference, right? And
Right.
so what a lot of people do is say, oh, easy money, let me make as much from this trade as possible, so they lever up a ton, right?
Right.
And I guess my question is do we have to worry about overextended players blowing up here? Because the dollar yen carry trade, it's not always there, but it's been there a lot over the past couple decades. So people get very accustomed to treating it like it's permanent. So is there anybody who's too over leveraged who's getting caught flat-footed right now, do you think?
Yeah, well, that's why you're seeing a lot. But yeah, the answer is yes. That's why you saw such a drastic sell-off in a lot of these large cap names and saw such a big run in small cap stocks, is because of that. All of a sudden, I'm getting a margin call, and so I've got to sell my long positions and I've got to cover my short positions. So it's just caused this, man. This is why you saw Nvidia down sharply, Eli Lilly down sharply, Google, Meta. Because those are the stocks that these hedge funds all hide in, because they're highly liquid. They're the companies that produce earnings, and they were heavily long those stocks to outperform the index. And so when the margin call came, they had to unwind all that. And that's why you saw such a violent rotation in the overall market.
Got it. And this is why you were saying earlier that rotation is mechanical, not sustainable.
Yeah, exactly.
All right. Well, second to last question, and we only need to spend a few seconds on this, but China is back trying to re-stimulate its economy now. Remember coming into 2024, there was the narrative was sort of like, hey, China's back to growth again. This is what's going to really power the global economy in 2024. China has been sputtering, much more so than people were expecting it to. So now they're stepping in and trying to take measures to goose their economy. What repercussions, if any, do you expect that to have for the rest of the year?
It's hard to tell right now.
Yeah.
There's a lot of this. There's a lot of things that are going on in the headlines that not necessarily are going to show up in the markets or the economy. So again, it's just really hard to say, okay, well, this is going to lead to this. And to be honest with you, I don't have the answer for you.
Okay, that's fine. Like I said, don't need to spend a ton of time on it, but it's, of all the things you're looking at, it's not at the top of your radar right now.
Yeah, not right now.
All right.
Just real quick, this is this chart right here. I just wanted to bring this up. So this is the carry trade. So this is the advanced decline line versus the Japanese yen in green, and the orange line is basically the S&P 500. And what you'll notice is there's a fairly high correlation between ebbs and flows of that carry trade versus the S&P 500, which you would expect.
Yeah.
Right. So it just goes back to the whole leveraging issue. But that's just kind of a visual of what we're talking about in terms of the carry trade itself.
Okay. So very much part of the game.
Yeah.
All right.
And that's a 20-year chart, by the way. So that goes back to 20 years.
Okay.
So like you said earlier, this isn't a new thing. It's been going on for a while.
All right. So I want to get to some of the data that we just learned this week, like the surprise to the upside on GDP growth, and some of the questions that opens up. Real quickly, you mentioned SimpleVisor by name earlier. It's probably been about, I don't know, a month and a half or so since you kind of gave everybody the walkthrough of the new SimpleVisor service here. I'm just curious. Do you have an update on it? Like, how's it going?
It's going great. We're in the process of we are working with Fidelity to have all these portfolios launch on SimpleVisor. So while we're working through that mechanical process of, account opening and custodial issues and all the SEC regulatory issues, we're having to register a firm just to do this as a separate entity. So there's just a bunch of legal stuff we got to go through. But while we're doing that, we're also continuing to upgrade. We're about to bring online an artificial intelligence bot that will help go through and scan all the stocks in the S&P 500 and give you a list of stocks every day that are either picking up in momentum or seeing unusual option activity or a variety of other indicators. So we're constantly developing new tools to help our investors manage money better.
Please tell me you're calling that new service RAI.
Exactly.
But you guys have been using it since it's now out in the world, and your
Yeah.
clients have been using it and whatnot. I mean, getting good feedback? Is it
Yeah.
getting good ideas that you're having to go back and
Yeah.
make changes, or what?
No, absolutely. We're getting a lot of great feedback from people that have said, hey, can you do this? Or, hey, I caught, there's, as whenever you launch a new website, right, there's going to be bugs here or there. So, we've been fixing critical issues, fixing bugs. We've gotten a lot of great feedback, and we're implementing, and we make a list when somebody comes up with a really good idea. We put it on a list, and then we start developing it. So a lot of the commentary that we've got coming back from users is helping us actually develop some really cool tools for the near future.
Okay, and just a quick reminder for folks viewing, if you didn't see the deep dive that we went through, like I said, about a month and a half ago on this, there's a lot of people, a lot of different camps that SimpleVisor is very well suited for. But I think two really big ones are if you're a DIY investor and you want to be looking at what a professional financial advisor, specifically here in this case, Lance and his team, are doing, even though you guys also have different portfolios that are allocated by other famous portfolio managers in there. So they can choose not to just look over your shoulder, Lance. If they want to look over the shoulders of some of these other greats, they can do that too.
Absolutely.
But you've got, all the data in the world that you could hope to have there. Like I said, it's sort of like, look to my eyes like, 90+% of what Bloomberg offers to you for like 1% of the price. It's fantastic for the DIY investor, and it's also fantastic for the investor who's just getting started, who doesn't have enough capital yet to really where it really makes sense to have a managed relationship with a financial advisor. And your job is mostly just to be putting money away month after month to be able to get up to that threshold where you can qualify for management. But what you're doing is you've got a lot of tools and other resources there to help guide you in that process, but also help you kind of learn about how the market works. So by the time you do have enough capital, you're informed enough to have a really, useful discussions with your account manager when they come into the picture of, hey, this is exactly how I want my account managed. So anyways, if you fit in one of those two buckets, SimpleVisor is really good for you.
Thank you.
All right, so bullet point number 2.
Oh, finally there. Okay, great.
Yeah, we're finally there. So we got the Q2 GDP growth numbers in. They were substantially higher than what was expected. I think expectations were 2.0% GDP growth. They came in at 2.8. Headline number. Now I've seen people, again, open the hood and look inside and say, okay, maybe this isn't as impressive as it seems. But here's where I'm going with this, Lance, which is the street has been, listening to Powell, who's been talking about, hey, we're finally seeing the disinflation we want. I think we're going to be able to start rate cuts at some point in time. The street's been dying for this news. Everybody's expecting rate cuts by September now. But can Powell cut when we have GDP beating like this, right? So more robust than expected GDP. The Fed's favorite inflation indicator expectedly jumped in June. I think that's PCE, but it could be wrong. But we just had that just came out. I'll pull up whatever data point it was. But we basically had a rise to the upside in one of the key inflation indicators that the Fed watches. The savings rate continues to slump, and that in itself is somewhat of a stimulus to the economy. If we're choosing to save less, that means we're spending more than we normally do, and that acts as a stimulus. Unemployment is still relatively low at 4.1%. Yeah, it's creeping up, but it's still relatively low. We just had a an all-time high in median sales price for existing homes, right? So real estate market prices are at all-time highs for the most part, at least for existing homes. And the markets, despite the recent sell-off, are still close to their all-time highs. Like
Right.
all these things I just mentioned are not arguments for easing. In fact, they're typically arguments for tightening. So can the Fed really cut even in September with a macro environment like this?
Well, so first of all, let's back up just a little bit. So this is the first estimate of the second quarter GDP. The Atlanta Fed had it pegged at 2.7, so they came at 2.8, so just a tenth of a percent higher than the Atlanta Fed. But the first estimate is simply just a summation of blue chip economist estimates. The Bureau of Economic Analysis doesn't have any data for the second quarter right now. It's all just now coming in. So they're going to be getting all that data. So the second estimate and the third estimate will be much more realistic to where we are. So, but as you said, under the hood, you look at it, it was a lot of government spending. It was inventory build, which is not healthy.
Right. Yeah.
So that means that we're piling up inventories because they're not selling. And that's one of the bigger issues. So I suspect that we're going to see GDP revised down over the next couple of quarters, not up. And a lot of the data that we're seeing coming in, personal spending came in at half of what was expected. So it's certainly showing that the consumer is becoming a bit more stressed than what we've seen previously. Retail sales have been very lackluster. That's about 40% of personal consumption expenditures. That's not great. And so that's all going to feed through on this. PCE came in on kind of on the screws, 0.2 versus 0.2. So not a whole lot of concern there. But the Fed looks at the trend mean PCE, which strips out volatility. So again, that's trending lower overall. So again, when you take a look at what the Fed's looking at, they're looking at trend mean PCE and they're looking at unemployment. And both of those are reaching areas which are historically, again, whether you use the SOM rule, I've got a report coming on this on next Friday on employment, but there's a lot of these employment indicators that suggest the economy is slowing down a lot faster. So the Fed has a choice. Either they can wait until they get caught by a recession, and then they're going to have to start cutting rates too aggressively to get that down, or they try to move a little bit early, cut rates, a quarter basis point here, a quarter basis point there, sit back, see how the data reflects, and try to nail this soft landing, which is going to be challenging at best anyway, but that's what they're going to try to do. So I fully expect them to cut rates in September. They might postpone that cut until November if they're worried about being seen as influencing the election. They could postpone that till November.
Okay. Well, it's really interesting. Okay, so I just went through that whole litany of reasons why optically, I think it's hard for them to sell this. Now they can say, hey, we're looking at underlying data that just makes us a little bit more concerned about where the economy is, and we don't want to wait too long, right? Now, of course, the big risk has always been if they cut too early and inflation isn't fully dead, then we get back into a 70s style situation. And Powell has said many, many times, essentially, I don't want to be Arthur Burns, right? So
but we don't have any of the ingredients for 70 style inflation, even if you cut rates.
Well, he just better be right on it, right? From what he said, I mean, it would zorch whatever credibility he has left if he were deemed to have cut too early, right?
The debt's the biggest issue, right? You've got to cut rates because of the debt levels. So again, you just can't sustain high rates in an environment where you have as much debt as you have today, with wage growth slowing, with manufacturing slowing. Take a look at most of your Fed regional indexes are all in contraction territory. That's not an environment that particularly with inventory builds, that's not the base case you need for an inflationary spike if you cut rates. So the thesis is where a lot of the economists are wrong is they say, well, if you cut rates, it's going to stimulate all this activity. That's not really the case because most consumers, they have no money. You can cut rates. They're already in debt up to their eyeballs. They can't go take on a bunch more debt. And the banks aren't necessarily in the mood to lend it to them. So especially in that. So you'll cut rates and you may get a marginal pickup in activity by the reduction in rates, but you're not going to have this massive impact. And again, everybody's reflecting back to what we saw in 2020, where you had this massive uptick in inflation. That's because you gave everybody $1,000 to go
Right,
spend.
right. There was
Right.
massive stimulus. Yeah, yeah.
And you shut down the economy. So there was no production of supply. So you had massive demand and no supply. Now you've got too much supply, not enough demand. So even if you cut rates, it's not going to flip that balance.
Well, and as I've been saying too, even if you flip rates, it's going to be quarters before you even see the impact of that, right?
Correct.
So anyways, it's interesting. Like I said, you know, I think there's still you know, it's a valid question with all these things. Is it really time to start cutting right now? Now,
If you listen to Bill Dudley, he says you should be cutting now.
that's where I'm going, right? So then we have, and Bill Dudley, very interestingly, had been on the other side of the equation,
Yeah.
right? He was all for higher for longer.
Yeah, he's very political. Remember, he wanted to hike rates when Trump was up for re-election. Now that you've got Harris running for election, all of a sudden he wants to drastically cut rates. So he's got a political horse in this. So
Okay.
I discount a lot of what he says.
Okay. All right. So I'm glad you said that, just because that's the question I was going to ask, because the next thing I'm going to say is, so Powell is thinking, you know, I think I'm going to cut in September. Again, there's a murky environment whether he should or he shouldn't. Bill Dudley, a former Fed exec, has come out and said he should be cutting now in July. I just talked to Thomas Honig, who is another former Fed official. He thinks the Fed should go higher for even longer, right? He's saying, look, if your goal here really is to kill inflation, make sure it gets under control. I think honestly, Powell just should shut up and just let the data do the talking for him. And you know, much more important to get that inflation done, and then, you know,
Yeah, and look,
attend to what comes next. So I'm just pointing out the fact here that you've got lots of different ways to look at it. It's not a simple decision at this point.
Yeah. No, and I don't necessarily disagree with Honig, because you know the risk though that you run is that if you take a look at the data, there's clear cracks in the data, right? And you take a look at leading economic indicators, you take a look at yield curves, you know, so forth, so on. You know, temporary hires are dropping rather sharply. That's a pre-recessionary indicator. Your unemployment rate's above the 12-month moving average. That's typically been a recessionary indicator. So there's a lot of these indicators that have been wrong for the first time ever, because of all of this stimulus and stuff that we've had going through the system. You know, the big risk, and I think Powell recognizes this, is that if you wait too long and you get behind the curve, it's, you know, really problematic at that point, because you can cut rates, but if you're too far behind the curve and the economy is dropping into a recession, you wind up into a deep recession, which is the one thing that they're trying to avoid, right? I think they're okay with a mild recession. I think they're just trying to avoid a deep one.
Well, and so history certainly shows that that's the Fed's pattern, right?
Yeah.
I mean, every recession in the past 40, 50 years has been preceded by rate hikes hanging out for a little while, and the Fed scrambling to cut, saying, oh my gosh, the economy is slowing faster than we thought it was going to. So will that happen here? Probably, right? You have a pretty good argument it'll be different this time. Now, I know Powell has said, hey, when it comes to inflation, I'd rather have that happen than be wrong the other way. Because he's sort of like, we know how to stimulate the economy. If we need to inject the patient with adrenaline and get out the defibrillator and, you know, whatever, we have the means to do that, right? And that's why so many people think, and I think you're in this camp, we probably will start having the wheels come off, and then we'll have yet another massive central planner response, right? So we'll be going into sharp disinflation, maybe even a little deflation, then reinflation and stagflation and all that stuff, right? Okay. I want to move on to the S&P chart, just to give folks the latest sense of where our technicals. Real quick before we do, though, let's talk about the yield curve for a second, because it is looking like the yield curve, which has been one of those recessionary signals, right, that we've just kind of gotten numb to, because it's just been stuck in un-inversion for so long now. It does seem that curve has been moving towards, depending which one you look at, but I think the more common ones look like they are headed towards un-inversion.
Right. Which, by the way, the inversion is not recessionary. It's the un-inversion that is your recessionary signal.
Right, but you have to invert before you get to the un-inversion.
Right. That's what I'm saying, is like, yes, it's been inverted for a very long time, and everybody's like, well, see, it's inverted. We don't have a recession. That's not the recession. The recession is when it uninverts. That tells you when you're actually having economic problems occurring. And so
And that's
we're
why I'm
just,
bringing it up right
yeah,
now,
yeah,
right? As we're finally looking like we're near that point, right? So
correct.
what does that mean to you as a guy who's been saying that for 2 years now?
Well, no, I mean, it's something we're watching very closely. And again, just because it uninverts doesn't mean you're going to have a recession right away. Because again, we won't, goes back to the Fed, right? The Fed's working off lagging data. So they're trying to make policy changes on data that's 6 to 9 months old in a lot of cases, particularly when it comes to housing and other issues. So, the problem is trying to look forward, make policy based on lagging data. And the same thing with the yield curve and inversion. The yield curve is going to invert. We're still not going to be in a recession, and we won't know that for 9 to 12 months. 9 to 12 months from that uninversion, we'll look back and go, oh yeah, that was when we went into a recession, because that's when it'll officially be announced. But the data is going to take a long time to catch up with that signal. All the signal's telling you is that the market is starting to recognize that there is an issue of economics going on that is causing this uninversion of the yield curve.
Okay. And so I just want to kind of connect some dots for folks. So this has been one warning sign that we've been waiting to see when it happens, right? When the curve uninverts. We are getting close to that, and that would probably be a precursor, I would think, Lance, to seeing trouble in credit spreads. So, if we do indeed get to inversion, then I'm imagining your focus is going to go even more to credit spreads to say, okay, did the starting gun go off, and are the runners starting to move yet or not, right? And of course, you won't worry too much until you start to see those credit spreads widen.
Right. Yeah, I mean that's really what it all comes down, because that's all the yield curve is, right? The yield curve. What is the yield curve? The yield curve is the spread between two different yields: 10-year, 3 month, 10-year, 2 year, 5 year, 1 year, 30-year, 5 year, whatever. There's about a billion. Everybody looks at different yield curves, but that's all it is yield spread. So yeah, once you start to see that uninversion in those yield spreads, then you start looking across other measures of yield spreads, corporates versus treasuries, corporates versus junk, et cetera, and look for those underlying indicators that are also suggesting that credit is moving into what is more normally seen during a recessionary environment. We don't see it yet, but we should if we start getting there.
All right, and just a commitment again to the viewers here, as we start to see meaningful movement there, we will be reviewing that every week on this channel.
Sure.
All right, Lance, well, can you pull up the S&P and just sort of tell us where we are? How much did we bleed off in terms of the overbought territory we were in? What DMAs are we near here? Did the floor become the support? Yeah, looks like it kind of did.
Yeah. So and it's interesting. I wrote about this past week, is that this is very similar to what we saw back in April of this year. So if you kind of go back over and look at this kind of sell-off we had in April, we came down, we tested the 20-day moving average, broke below it, rallied back above it, hung there for a couple of days, broke the 20-day again, then took out the 50-day at the blue line, and then tested the 100-day. Did the same thing here, came down, violated the 20-day immediately. I started getting emails. We broke the 20 days. Does this mean get out of the market? I said, patience, got to wait. Market came up, stayed above the 20-day for a couple of days. Then we took it out. Here's that 2% down day that we had. Took out the 50 yesterday. And again, broke the 50. Be careful, because markets have a tendency that once you violate these trends, they tend to recover it at least for a couple of days. So this bounce that we're having today, very expected, could go another day. We could rally all the way back up towards the kind of this 20-day moving average over the next couple of days, because we are decently oversold. We're still on a sell signal, which suggests that there is pressure downside on prices. So we're still in this corrective phase. That's not over yet until that signal flips back to a buy. But we're oversold enough here for a bit of a decent rally, kind of like we saw back in April. We had this decent rally, took us back to the 50 and the 20-day, sold off again, formed a higher low, then we took off for the next rally. So we're working through that process. So again, we're down about 3% from the peak, somewhere around there. We could, pull this out down towards the 100-day moving average, which right now is down around 5,300-ish, as potential downside. But I would use rallies at this point. If you got caught off sides with this, we sold stocks last week before this correction really kind of got underway. So we don't have a lot to do at the moment, but on any rally, this is where you look at your portfolio and say, you know, this stock's falling out of bed, this stock's doing okay. Maybe I here I'm looking to maybe add some exposure. I kind of wait on that for right now. Let this market kind of work itself out, but take some action on this rally to rebalance your portfolio and rebalance risk, because there is some downside pressure until we get back to that buy signal, and we've got a good bit more work to do through this corrective cycle. It could take another, you know, couple of weeks before we see the bottom of this.
Okay, so it sounds like, because you know you've been predicting essentially what's going on right now, and you know you've said, look, it's more likely than not going to be kind of a normal correction, 5-ish, 10% maybe, and then there will be good entry points that, you know, a lot of investment firms, yours included, will use as an opportunity to get into names you liked now at better valuations. Sounds like you're not yet in buy mode.
No, not yet. And again, because you know, we could go back to taking a look back at last October, because you know this cycle right here was the July, August, September, October period of last year. We were down 10% in total from peak to trough. We could be entering into that cycle. So again, you know, you have a sell off, you break the 50-day moving average, you rally back above it. You know, you kind of watch for, you know, kind of the market conditions. You know, and last summer we kept seeing more and more pressure on the overall indexes from different areas, and so there was no reason to start buying. And then, of course, right around it was about a week or so below, before the end of October, we wrote an article that said, you know, hey, a little bit more weakness in October before we see the year-end rally, and we laid out all the reasons why we get a year-end rally, and that's where the market started rallying. So it's too soon to look at this current cycle and say, oh yeah, you know, we're completely past, you know, all the risk, you know, get in now. It's way too soon for that. Typically this sell signal, buy signal, it needs to work itself off a bit, and we're only about halfway through that cycle. We're oversold enough for a rally, but I think we got some more work to do to get the signal low enough to say, okay, now we're to a point where we've got the markets worked off enough to, you know, allow people to get back into the markets. And more importantly, this is kind of what we're covering in this weekend's newsletter, is that investors are still very exuberant, right? You know, back in October, at those October lows that we saw last year, pessimism was rampant. Nobody wanted to be in stocks. Everybody's convinced the market was over, back into a bear market cycle, and that was the buying opportunity. We've still got the professional investor sentiment near highs as of the end of this week. Household allocations are near record levels at the end of this week. That's got to reverse, and that's going to take a little bit more of a correction here to get investors bearish on the market and get that sentiment worked off, so that we can have a good entry point to add to exposures.
All right, all right. Well, I guess now's as good time as any to ask you about your trades, but I'm going to guess what you just said, you probably haven't done very much over the past week.
We did everything we needed to do last week. So this week we've kind of just been, you know, sitting around kind of watching, you know, performance of the different portfolios. You know, 3M has had a fantastic week today. It's up 15% today. So a lot of our dividend yielding companies in the dividend equity model have caught a lot of this rotation. So that portfolio has been doing very well. And the 60-40 allocation bonds have been doing very well this week. So that's helped that performance, but also since we reduced our exposure to the mega cap stocks, all our other holdings like AbbVie, ExxonMobil, et cetera, those have done well this week. So we've actually done a fairly decent job of outperforming our benchmarks this whole week.
All right. Oh, well, congratulations. It's going to make you feel good in a week that certainly made a lot of people jittery.
Take what I can get.
And again, you know, maybe I'm talking your book and mine here a little bit, but you know, folks, again, this is sort of the benefit of that a good professional financial advisor can bring to you is, you know, the depth of expertise on how to really create a diversified portfolio and to know where we are in these market cycles and to have strategies in place for them. You know, when you're just sort of on your own as a DIY investor, sometimes, especially if trades start going against you, it can kind of feel like the world is on fire. And of course, you start making really bad decisions. So to be able to leverage somebody who's just a cool hand on the tiller and can craft portfolios that can, you know, make times that are generally turbulent, feel more specifically tranquil for you, can certainly pay, big dividends over the long run. All right. Well, look, as we begin to wrap up here, Lance, I realizing I didn't mention this earlier, and I should have led this video off with it, which is last night I had a little celebration late at night with my dog because it was just she and I here. The rest of the family was out doing different things. But we were watching the Thoughtful Money YouTube channel subscriber counter tick up to 100,000 subscribers. So we finally hit
Nice.
it. Yeah, wonderful to hit in under 9 months. So just under 9 months, we were able to hit that, which I hear is pretty great for a new channel like this one. So yeah, so we had a lot to celebrate last night. I want to make sure that everybody here is part of that celebration. For hitting 100,000 subscribers, YouTube supposedly will send a fancy little silver plaque here, and I'll commit to folks that when I get it in the mail, I will do the unboxing live on this weekly market recap with Lance, so we can all experience it together.
Nice.
But I can't thank enough all the people who are watching right now, who have just been, great supporters, champions of what we're trying to do here, recommending it to family and friends, sending me daily, both great words of support and encouragement, but also great ideas for topics you'd like to see covered or guests that you'd like to see on this channel. Sort of the goodwill and the personal investment of this viewing audience is just off the charts, and it's just such a privilege to be a part of. So anyways, folks, congratulations to all of us for hitting that milestone, and a huge thanks for each and every one of your role in it. And Lance, you're a big part of that too. You're on this channel every week. You're a huge part of the experience here. So thank you for dedicating as much of your time and your expertise here.
That's my pleasure. I enjoy doing it. Congratulations. That's really great.
Thanks. It is pretty wonderful. And I want to use that to sort of segue into today's closing topic, which I haven't put a lot of thought into, Lance, but I do get a sense it's sort of near and dear to your heart, which is, if you want to be successful, first you got to do some goal setting, right? You got to put a stake out there, on the ground that, all right, I'm gonna go after this, right? And then I'm not trying to be too overly simplistic, but it really is just a function of effort over time, right? For folks who've heard, I'm blanking on the guy's name, I'll pull it up while we're talking here. But Atomic Habits, that's really what it kind of breaks down to. He's all about goal achievement, and he calls it Atomic Habits because he's trying to break it down to the smallest possible steps, right? And it really what it is it's just effort over time. And if you apply yourself over a long enough period, your odds of hitting your goals are pretty good. And what's great about that is both of those things are in your control, right? You can determine how much time you want to dedicate to something, how many hours of your day you want to apply to it, and you can determine how much effort you want to put in. And if you put in more effort, well, that'll shrink the time that you need to hit your goal, and vice versa. And kind of on one end, you can, even the drop of water on the rock, right? Given enough time, will split that rock, right? And so what I'm trying to kind of use this hitting 100,000 subscriber milestone for people here is just to say, if there are things that you want to accomplish with your life, even if they feel, pretty unattainable, if you just commit yourself and every day you just, try to take another step or several steps forward to that goal, odds are good eventually you will hit it. Now, there's one other factor I think you want to bring into the equation, which is just sort of smarts, right? There are many different ways to do the same thing. And yeah, if you're dropping water on a rock, you'll eventually break the rock. Now, you might have to wait a couple of centuries for that to happen, right? So there might be a smarter way to do it. Maybe you want to look for a crack in the rock and then go buy a jackhammer, and you're going to crack that rock a lot sooner, right? So you definitely want to be not just working harder, although working hard is a big part of the equation. You want to work smart too. Lance, I've had enough of this experience in my life where I've taken what they call a BHAG, right? A big, hairy, audacious goal, right? And at the start, it feels like, my gosh, is that really realistic? Right. But I've found that if I if I just put the effort in and I do it for long enough, I'm eventually going to hit it. And then along the way, I usually find ways to iterate what I'm doing to do it in a little bit of a smarter fashion. And that usually acts as a catalyst. And in general, oftentimes you'll hit the goal faster than you imagined you would starting out here. And I say this because, look, I'm bringing this up because I've got, college age kids, and they're stepping into the world. And I think they feel like a lot of life goals to them feel pretty hard to attain at this point. Even sort of what used to be standard ones, like, oh, I'm going to own a house, right, at some point in my life, right? These kids, my kids at least, I'll say, understandably, I think, feel a little bit like, wow, this feels kind of overwhelming. Am I up to the task? And so I'm having this conversation with him as well. But I wanted for you and I to just bounce around for a little bit here, because I imagine there's a lot of people watching this channel who have goals of all shapes and sizes that they haven't picked up yet, or are questioning, really, is that something I'm going to be able to do? And I just want to give them that little pep talk of like, look, almost anything you put your mind to, you can achieve. And if you give yourself enough time and enough dedication, you will achieve it. The question is can you put that formula together and maybe sprinkle little smarts in there and get there, on a timeline that's going to be meaningful and beneficial for you?
Are you familiar with the story of the bananas?
I don't think so.
Okay, are you familiar with the baseball team called the Bananas?
No.
Okay, you're not. Okay, so I'm going to butcher this story a little bit. He tells it a whole lot better. The guy that actually started the Bananas, but it's a baseball team, and when you talk about having an idea that you really believe in, something that you want to do, and then just put some effort into it and it'll work. That's not really the case. And his story I think is really good because it goes to I've worked with so many different business owners over time, and the difference between success and failure really comes down to one thing. But let me just kind of encapsulate his story real quick. So he started this baseball team, and in the first 2 years, he sold 2 tickets, and he basically invested his capital into the company and was trying to build this baseball team, and it just wasn't working. And he was on the verge of bankruptcy, and his wife looks at him and she says, "Do you really believe in this?" And he goes, "Yes, I really believe that this is something that is worth doing." And she says, "Okay, fine. We're going to sell our house. We're going to go buy a crappy apartment in the worst side of town," which they did. And she says, "You go do this and don't quit until you get there." And again, I'm encapsulating. So he did, and he studied Disney, and he studied, what people hate about Major League Baseball games. And he started changing all those things. And he went from not selling 2 tickets in 2 years. He recently just sold out a Major League Baseball stadium, sold out Fenway Park, I believe, just recently as well. So, he's gone to just great success. So if you don't know the Bananas, Adam, go.
I'm going to have to check it out now. It sounds fascinating. Yeah.
It's on TikTok, but basically there's 2 teams and they play each other, and they do all kinds of crazy stuff, and the umpire dances and they make it very entertaining. And if you hit a foul ball into the bleachers and the fan catches it, you're out. So he's changed all these rules. There's a minimum time at bat. He's changed all these rules to make the game go a lot faster, be more entertaining, and it's blown up, and he's doing fantastic. But the point is that it's great to have an idea, and it's great to put in the effort. But the thing that separates success from failure is that the first time you hit a roadblock, most people quit. And so you've got to have an undying belief and tenacity, and whatever you're going to go after, you've got to say, "I'm going to do this with a 150% of my effort. I'm going to sink everything I've got into it." And because once you do that, you don't have the ability to fail. So you have to make it succeed. See, the difference between success and failure is the people that succeed, they didn't have a choice. They had to succeed, because if they failed, they were destitute, they were homeless, whatever it was, because they put everything into it. If you go into an idea where it's like, well, I'm going to try this, and yeah, I'm going to work at it a little bit, but I'm going to keep my cushy job over here, and I'm going to, I'm not going to invest any of my own capital in it, and whatever it is, you're probably going to wind up failing, because the first time you hit a hurdle, you'll say, that wasn't really working anyway, so I'll just quit and go do something else. because you weren't committed. You've got to, if you want to succeed, you've got to commit with everything as if your life's on the line. And if you do that, you won't have a choice but to succeed. And, even myself, when I did this, when I started my business, I lived out of my truck for 3 years because I put everything into my business to get it to grow. In the first 3 years, and I gave myself absolutely no choice not to succeed because there was no alternative other than to eventually build success.
Okay, a great story. I agree with everything you're saying. I kind of think we're saying the same things, maybe just using different words, right? Where, to talk about effort, right? I mean, effort is part of commitment, intensity,
Yeah,
right?
but you can put in effort. But if you've got a fallback position, it's too easy to quit,
Right.
right?
Well, and if you quit, that's the time, and you've just ended the clock, right? So,
Right.
but my point is to again, I think we're saying a lot of the same things, which is if you keep going, right, and you evaluate along the way, okay, what didn't work? Okay, how do I do it differently next time, right? Just like the bananas guys, right? The first couple of years, he wasn't selling tickets. Okay, I haven't nailed the formula yet. What do I keep? What do I change next? um, you are more likely to get where you're going as long as you remain committed, work hard, keep at it, right? And I'm telling people this because I think for a lot of people just starting out, sometimes it's kind of like, well, what if I try and it doesn't work and then I'm a failure, right? And the point you're making, which I 1,000% agree with, is no,
It's
you
not
just
gonna work.
you just figure you expect it not to work initially, right? And you just
Yeah.
figure out, okay, my job is the next day. I wake up and I pick up what didn't work and I look at it and say, how do I improve this at least a little bit and just keep going forward from there, right? So,
Well,
and
it was Madison.
undoubtedly when
Yeah, it was
pardon?
Madison Square Garden, not Fenway Park. Sorry.
Okay, Madison Square Garden. But I also wanted to score for folks too that like, there are going to be a lot of days throughout the process where you're going to have lots of big doubts, right? You're going to have big setbacks. You're going to be just turning the crank and not seeing anything come out of it, right? Which is why you just, on those days, you just want to have faith in the process, right? That like, even though it feels like the world's against me today, even though I failed yesterday, if I get up, get my feet on the floor and start going through this thing again, you keep doing that long enough, you will find a different way to do it, a better way to do it. You will open yourself up for serendipity to come into your life. You'll get better at recognizing serendipity when it passes by and grabbing onto it with both hands. So, this is more or less intended to be a pep talk for folks to say, hey, look, yeah, it's going to come oftentimes with a lot of work, a lot of commitment, and a lot of uncertainty and whatnot. But if you want to make it happen, with enough dedication, commitment, hard work, and time, you will reach it. The other thing
Well,
on this, oops, sorry, go ahead.
no, I was just saying it's the old adage, which is, every overnight success took 10 years, right?
Yeah. I've got, I know a lot of successful entrepreneurs who were 20, 30-year overnight successes. Yeah.
Yeah.
All right. And then kind of combined to this is, a big, a little bit of advice, and it's going to sound a little contradictory, but I don't think it is, which is, one of the things you find out when you go into business for yourself is the more people you bring into your orbit or that you make your business success dedicated to, the more risk you have, right? And one of my mentors very jadedly told me early on, hey, one thing to remember about people is that people disappoint, right? And that is very true. Nobody's perfect. Nobody's going to delight you 100% of the time, but certainly in business partnerships, there's definitely a fair amount of risk, even in the best of scenarios, that the partnership doesn't work out. And the more partners you have, the more you multiply that risk, right? And the same mentor also had another really important bit of advice to me, which was, if you don't have 100% control of your business, then you have zero, right?
Right.
So like no matter how the equity structure or the voting structure is broken down, he's like, if you don't have the ability to really direct the business the way you want to and all the important decisions, then you are vulnerable to the other stakeholders basically gumming up the works and derailing what you want to build here. And there's a lot of truth in that too. So to a certain extent, it's like if you want to be really successful as an entrepreneur and do it your way, kind of the going it alone strategy has a lot of benefits to it. And being super transparent, that is the road that I am taking right now, business structure wise, with Thoughtful Money versus the business ventures I've been involved in before. I was either somebody's direct employee, or then later on I had partners. I've gotten to the point right now where I've got a really clear sense of what I want to build for my constituency. And I don't want to get derailed as I've been in the past by my business partners. Now, on the flip side of that, there's the old adage, which I think has a lot of truth in it, which is if you want to go fast, go alone. If you want to go far, go together. So, you do want to leverage good, maybe partners is a different type of partner, right? Where it's not necessarily a co-investor or co-equity holder in you, but strategic partners, right? That can help you, you all complement each other, right? What you do well benefits them, what they do well benefits you. Build your basically team of people who can act as catalysts for you like that. And maybe just bringing it back to myself here at Thoughtful Money again, that's what I've been trying to do with key players. And Lance, you're right there at the top of the list, where we have our own businesses, but we've found out ways for our businesses really to benefit each other's constituencies and create a pretty good friendship in the process.
Yeah.
And so, where I'm trying to go with this is to be very mindful of who you let in, be very protective of the key things that are most important in a business or in a goal, which largely has to do with control. So be very, very, very guarding of your control ability, but also look out there for the key catalysts who you can create these mutually beneficial relationships with, that can take you a lot farther, a lot faster, hopefully, than or at a scale that you just couldn't get to on your own, right? You're nodding. I'll let you talk in 1 second, Lance, but before I do, I do just want to take a quick beat and just give my sincere thanks to you as a business partner. It's been great. I don't think I need to explain it for folks because they see you here on this channel. They see the value that you bring here. But one thing that maybe they don't know that I think is just important to share is the sign of what a really good business collaborator can bring. There was a movie called The Town. I think I'm remembering right. It's a movie with Ben Affleck in it. Jeremy Renner I think it was like Jeremy Renner's kind of breakthrough role. And these were guys who grew up in Southie. I think they were actually criminals, but
no, they were actually criminals.
Yeah. So there's a scene where Ben Affleck gets in trouble, and he goes over to his buddy's house, Jeremy Renner's, and Ben Affleck's decided I got to go basically beat up these competitors, right? And he walks in the room. Jeremy Renner's there on the couch, and he says, "Look, I can't tell you where we're going. I can't tell you why we're doing this, but we got to go hurt some people." And there's like a pregnant pause because he just sort of sandbags Jeremy Renner out of the blue with this news, and Renner just thinks, looks, and says, "Okay, when are we leaving?" Right? Just doesn't question it, doesn't ask, just says, "Buddy, I got your back. Right? I'm on your team. Whatever you ask me to do, I'm your ride or die. I'm right there with you." And you multiple times have done that for me. And I remember, I'll never forget, leaving my previous company. I couldn't tell you about my decision until I had made it. And I think it would have been totally understandable for you to have, 1,000 questions about why I made the decision, or Adam, what are you thinking of doing? And boy, I don't know, are you going where we want to go? And instead you just basically said, "Hey, I got your back, buddy. Where are we going?"
Yeah, absolutely. Well, I mean, that's the way good partnerships are supposed to be. And it is, I have partners in this business, and they're great partners, right? So, everybody's kind of got like their special skill set that they do. And I was talking about this on the radio the other day, saying that, what I do for our firm is the least important job of the whole firm, because it's just the money management side. The financial planning, the operations, all that Danny and Richard and Connie do are far more important, because when it comes down to growing people's wealth, it's about the financial planning. but it's important to have these really, really, strong partners. Everybody has very strong relationships. And, but the thing is that if you're going to take on a partner, and there's nothing wrong with partnerships, and you're absolutely right. If you want 100% control, do it yourself. The advantage of having partners is if they bring a skill set, but you've got to approach that no different than if you're getting married.
Yeah.
And, you just don't marry the girl that you meet at the bar, right?
Right.
At the first time, well, people have done it, but Vegas, I guess it happens all the time. But yeah, you've got to approach that, because once you go into partnership with them, getting a divorce is devastating. And there's so much legal issues and money and everything else that goes on. And you ruin great friendships. You may go into a business with, Adam and I, we're going to go start a business together. We're best of friends, and then something happens in the business. And not only does it ruin the partnership, but it ruins the friendship. So there's a lot on the line. So you have to really approach the idea of having partners very carefully. There's nothing wrong with it. But you do give up control, absolute control, to make decisions that you want to make, do things the way you want to do them, by having partners. But there are benefits to that. But it's something you have to approach very, very carefully and document. I mean, you need really good lawyers if you're going to take on partnerships to have a very strong fundamental agreement between everybody involved, saying that this is your responsibility, these are our responsibilities. Here's all these other things. But it's doable. But to your point overall, Adam, I think that, you and I have talked about this before on the show, is that capitalism gets a bad rap because of what we see in the corporate world, right? We see what goes on with, BlackRock and, Apple and Microsoft and all these other companies. And so, the younger generation coming up right now, they have a very bad taste about capitalism. Like, capitalism sucks. No, capitalism is alive and well. It works fantastic. There's no better system in the world for you to build your own personal wealth. But you've got to be willing, like we talked about, you got to be willing to take the risk, invest the capital, put it all on the line. And if you're willing to do that and push through, capitalism will work for you. Now, corporatism's got a whole bunch of other issues. Adam and I have talked about that before. We've got to resolve the corporatism issues at some point. Don't know how you do that, but at some point we'll have to figure that out. But don't be down on capitalism. If you really, you can be successful working for somebody else, right? You can be an employee and you can attain a level of success, right? And if your level of success is to have a good job and a wife and a couple of kids, and you're happy and that's fulfilling for you, you're successful.
Yeah, and sorry to interject, but it's like investing, right? Where you say, don't try to beat the S&P, just try to hit your goal and hit your goal with the least risk possible. For a lot of people, hitting their life goal with the least risk possible is being an employee.
Yeah, and there's
nothing wrong with it.
And there's nothing wrong with that. But if your view on life is, and I know I was this way, I've been this way my whole life. My view on life was, I want this and that, and I want all this other stuff.
I want the moon. Yeah.
Yeah. And it's funny because once you get there, it's like, I don't want that anymore.
Yeah.
But if your vision is that you want, to build real wealth and to have, tons of disposable income or whatever it is that is your goal in life, the only way to truly achieve that is through capitalism. And that's where you've got to start a business, you build it. The vast majority of our clients are people that have started a business, they grew it. In a lot of cases, they didn't make money for a long time, but they eventually built a value in the firm, and then they sold it, and they created this legacy windfall for themselves and their children. And that's the true nature of capitalism, and it's very attainable. It's very doable. You just got to commit to doing it and set some of this other stuff you hear in the media, set it aside and just focus on. And I tell this with people all the time: stop worrying about all this other stuff. Focus on what you do. If you're working for a company, focus on your job. Build more cash flow. Build savings. Build investments. If you're owning your own business, focus on the business. Don't worry about all this other stuff. It'll take care of itself. Focus on growing your business. And if you do that, you can't help but be successful.
So I think that's the important parting thing I want folks to take away from this. I guess maybe just a couple of qualifiers. One is this is for goal setting in anything, right? So it could be goal setting for relationships or whatever, but yeah, tactically, maybe Lance and I think a little bit about it more through the business lens. Um, and I agree with Lance. Again, the key thing I want everyone to take away from this is you will be successful if you follow, sort of the key tenets we're laying out here. Um, I would say like come up with your goal, like have it be a goal of what you want to achieve, and make it a real goal, not like I want to be rich,
Right.
right? Because that actually doesn't have a lot of meaning. Like Lance says, even when you technically hit it, you'll probably realize that wasn't what you really wanted to be going for anyways, right? But it's sort of like who do I want to be, or what type of impact do I want to have, right? And the reason why is that's what's going to carry you through the tough times, which is if you're waking up in the morning and there's uncertainty, but you're confident that you're making the type of difference that you want to be making, or you're being the type of person that you want to be, that's winning. If you get hit by a truck tomorrow and you haven't hit your money goal yet, you're still going to be happy about the life that you've been living, and the meaning and purpose that your life has had, right? And if you say, look, this is the goal I want to have, and I want to hit it in the absolute best way possible, financial success is highly likely going to be a part of that recipe anyways, right? So just sort of as a recap for people, even if the goal seems really big and hairy, with enough dedication, enough commitment, enough hard work, and enough time, your odds of hitting it are very good. You can be very protective of your control of your vision, as I was saying earlier, but realize that people can play a really catalytical event towards there. As Lance was really hammering home, you just have to be highly, highly selective. And it's like a marriage. When you enter into it, even if you were as selective as possible going in, stuff can happen along the ways. And so you've just got to be very, tending of those relationships. And some of them you're gonna find out are going to be even better than you could have possibly imagined, and hold on to those, as tightly as you can. Some of them are going to evolve away. And so you're going to want to know, okay, when's time to say, look, I thought this was going to be a great partnership, but it's time for us to part ways, hopefully as amicably as possible.
Yeah.
So, please, if anything, take optimism from this discussion, and maybe take heart in terms of like, hey, since we just were fortunate enough to hit this big goal with thoughtful money, and trust me, I've got an even bigger goal, to go hit next. Hopefully you maybe log off from this conversation and spend a little bit of time reflecting on, hey, what's something I really want to achieve in my life that I'm not working towards enough yet, and maybe start to give a little bit of more specificity around that vision.
Yeah. And look, I think you hit it. You just, what you just said there at the very end was really important, is that you just hit this one goal, right? So 100,000 views, that's also 100,000 subscribers. That's great. And I think that's with anything. And like, if you're investing and trying to save money, as an example, you say, wow, I want to have $1 million when I retire. Great. Don't use that as a goal. It's too big. Pick a small number. Okay. My first goal is I'm going to save $10,000. And then when you get to 10,000, pat yourself on the back. You achieved the goal, and then set the next level, then set the next level, but break this big goal. And this is why it has to be definable. Like Adam said, it can't be, I want to be rich, right? It's not definable, right? You can't break that down. You need a very definable goal that says, I want to achieve this, and then be able to break that down into smaller units that you can achieve. And that way you're constantly achieving success along the way. This works for a lot of things, just like getting out of debt. If you've got a lot of credit card debt, and a lot of people do, you need to get out of credit card debt. Credit card debt will keep you poor your whole life. So if you've got a lot of credit card debt, you've got to start focusing on getting out of it. Break it down. Take one credit card, pay the minimum on everything else, pick one credit card with the smallest balance, and just aggressively pay it off. Because when you get it paid off, you're going to feel good about yourself. Like, hey, I achieved this. I've got this one down. Okay, let's go get the next one, right? And you do the same thing to the next one.
Success breeds success. Yeah,
exactly. But if you don't have these achievable goals, everything just feels like a failure. It's like, I'm never going to get there. It's never going to happen. And then that's where you talk yourself out of doing whatever it is you finally give up. Give yourself reasonable, achievable goals that you can hit on very short-term basis. If you've got nothing saved up, I'm going to save $100 this week. Make it easy. Get that first goal right. And then when you get that goal, say, okay, I'm going to do $200 next week. Hit that goal. And then before you know it, it becomes habits, and things become very easy.
All right, I'm going to have to end it here, which is hard because now I'm getting fired up.
Yeah,
Topic clearly that Lance and I, near and dear to Lance's and I
yeah, it's a
hearts.
big one.
Yeah, if folks, you know, if you want to see us pick up on this, let us know in the comments section below. One thing I think might be kind of fun, Lance, for us to do if there's interest is, you know, there's such a thing as positive discovery in life, right? Which is like, okay, you know, learning best practices, you know, seeing people do things that you say, I want to emulate that, right? There's also negative discovery, right? Where you learn how you don't want to do things going forward, right? So like, you know, my parents got divorced when I was real young. It was a nasty divorce and there was a lot of, you know, animosity between them growing up. And I was just like, wow, I do not want to do this for my kids, right? And it's really, I think, helped me work on my marriage from day
Yeah,
one. Um, so if folks want to hear us maybe share some horror stories, but also just like things that we learned along the way, if like definitely avoid this pitfall, that might be kind of a fun thing to share for folks.
sure.
All right. Well, look, and wrapping up, folks, thanks for hanging with us here to the end. Thanks again, folks, again, for helping us get to 100,000 subscribers. Um, if you, if maybe, you know, your next big, hairy, audacious goal is to make it here next week to get your next weekly dose of Lance, please commit yourself to doing that by hitting the like button and then clicking on the subscribe button. And I hate asking people to do that, given all the pitches I've just made recently for folks to hit the subscribe button to get us to 100K. But if you haven't subscribed yet, please join the party and hit that button. I'll keep it quick, but for all the reasons that Lance and I generally talk about, highly recommend that most people should be navigating what's, you know, likely to come ahead in the markets. Not saying anything necessarily bad is going to happen, but definitely some uncertainty coming forward here. Highly recommend you do that leveraging the advice and guidance of a good financial advisor. If you don't have one or would like a second opinion from one of the ones that we have on the channel here every week, maybe even Lance himself and the team there at RIA, please go fill out the short form at thoughtfulmoney.com and you can have a free consultation with these guys. Fill out the form. It only takes you a couple of seconds. The firm will be in touch with you momentarily to schedule one of those discussions. While you're there at Thoughtful Money, don't forget, if you haven't already, click the newsletter link up at top, sign up for our free newsletter. And just a reminder that if eventually you decide to upgrade to the premium version of the newsletter, you get all sorts of benefits, but a big one is the Macro Pass service, which are research reports from all the different advisors that are experts that come on this channel every week. This week's a really, I think, timely one. So it's two reports from housing analyst Melody Wright. Now, folks may remember Melody was the Macro Pass participant or contributor probably only like 4 or 5 weeks ago. But why she's doing it this week is because things are beginning to move quite fast in the housing data. That's why I did sort of the emergency interview with her that's airing the day after this video comes out. So it's if you're interested in what's going on in the housing market right now, definitely watch the video with Melody. And if you're a subscriber to the premium Substack, keep your eye out for the for her 2 recent reports that should have been sent by the time this video comes out. All right, Lance, another great week. As usual, I'll let you have the last word.
Nope, that's it. See you next week.
All right, Lance, buddy, great to have you back from Greece. We'll see you next week. Everybody else, thanks so much for watching.